Hey everyone, welcome to the last video in the series, The Psychology of Risk Management. So let's get started talking about account durability a little bit. We obviously did a bunch of simulations and stuff, simulated equity curves that kind of gave you a visual idea, but I also wanted to talk about it again in greater detail, so really drill it into your head. Remember, lower risk per trade systems, percent risk per trade systems equals higher account durability, right? That's obvious. We can take more losses if we're risking less, right? Now, obviously, we don't want to take a bunch of losses, right? And what is the drawdown or the side effect, the con to a lower risk percent risk per trade? It means we have more potential to overtrade, right? Because we might be careless, especially when we're starting out, might be careless and take some low probability setups. I'm guilty of doing this, right? So we don't want to be sitting there with a 0.1% risk and taking 10 losses, in a day and saying, okay, I only lost 1%. Okay, but what trades are you taking, right? There's no way you're taking high probability trades if you're just smacking orders on everything, right? So something to be aware of. Conversely, we have higher risk per trade. It means we have a lower account durability, but it also forces us to take these higher probability setups, right? So I'm really more so referring, with the lower risk per trade stuff, I'm referring to the 0.5% risk per trade. It's okay to do it, but again, if you catch yourself just taking all sorts of trades, just realize that potentially you might have a problem there. Maybe up your risk a little bit to 0.5%. Unless you're managing like a huge amount of capital in like the 7 figures plus realm, then I would say okay, maybe risking 0.25% makes sense, right? But with a higher risk per trade, 0.5%, it'll kind of force you to take those higher probability setups because you're not going to want to just take anything, right? Now, we don't want to be in a situation where, again, our risk per trade is so high that we're fearful to enter prime setups, right? And on top of that, remember, we don't want it so high that it creates a risk of ruin in our system that's above 1%. Even 1% is too high. Remember what I said, right? So we want to find a percent risk that gets our emotions going just enough, and we want to up it a little bit, right? So maybe not even up a little bit. The only reason I put that in there is because I want you guys to push yourselves a little bit outside of the comfort zone. That's where you're gonna find growth in this, right? You have to have some sort of exposure. This is more applicable to a live account. Like say you have $1,000 account and you're risking 0.1%. You're risking $1. That's not really gonna do much for me personally. Maybe it does for you, but maybe if you're risking $5, for example. Again, it's $1,000 account. You're risking 0.5%. Maybe it's not doing much for you, but if you were to risk $10 per trade, then you're going to take it a little bit more seriously, right? Because then your risk of ruin's higher, right? Again, it's all about building the skill up, right? To be able to, basically, again, force yourself to take prime setups within your trading plan, right? It's all about building the consistency and the skill to be consistent, right? We don't want to play around with our variables, like I said before, right? But, if we do that, if you find a risk that works for you, that'll help you, get your emotions involved, right? Then we can train ourselves to actually, be calm traders and not be anxious when we're entering trades, right? I used to have this problem. I'd be, super anxious entering a trade with live funds, and honestly, it even happened in demo too, right? When I first started out. But eventually you get over it, right? You just have to stick with it and build that skill up. It's a skill that is trainable, right? So I want you guys to be aware of that. So the other thing I wanted to mention, double-digit drawdowns are mathematically harder to recover from than single-digit drawdowns. Obviously, the deeper we go into drawdown, past 10%, that's when it gets, a lot more difficult to actually recover. Now, I think there's also a study that talks about this, about double-digit drawdowns being psychologically difficult to recover from as well, but I couldn't find the link to it. I remember learning about it when I first started trading Forex. I learned it from, I don't even remember where I learned it from, but I couldn't find the link to it. But either way, listen, I think they're more so talking about, again, retail traders, which we are, right? They're talking about huge drawdowns, right? And let me explain what I'm talking about. So as you can see here on the graph to the left, right? You see how when we start getting really deep into drawdown, it actually requires us more and more percentage to recover, right? Back to break even. These are all the break even points, right? So remember what I was saying before, at a 50% drawdown, it's going to take us literally 100% gain from that 50% drawdown to get back to break even. You literally have to flip your 50% account, right? So to put it into actual dollar amount, 50K account, right? Say you start with a 100K account. You somehow manage to draw down to 50%. You now have to double your 50K account, obviously. What is 50K times 100%, right? Or doubled? It's 100K, right? So you have to make 100%, right, in order to get back to break even. That's quite the feat, right? I don't think I'd be able to do that, to be honest with you guys, right? Just being real. So with trading, the best defense is a good defense. Capital preservation should always be priority number one, right? Private investors don't really care about, huge returns with an unstable equity curve and huge risk and like a huge risk of ruin, right? Our total loss risk. They care more about long-term consistent gains, stability, properly managed risk, right? That's the key thing when we're talking about private investment. And honestly, it should be the same way for you, right? We don't want to be like Wall Street bets. I have to bring them up in here because it's like the absolute antithesis of what proper risk management is. I literally watched a video of a guy taking like 5K and then somehow leveraging it into like 70K and then losing it on live stream. I was like, what the hell is this guy doing? Like, there's zero account durability in that, right? Okay, of course there was a chance he could win, but if he's going to continue to, take trades like that, all it takes is one trade for him to lose his shirt, right? Guy went into 70K debt. Can you imagine that? So this is why we don't trade like this. I don't even think you can really do that in Forex anyways, right? Yeah, listen, it's an unsustainable approach to managing risk, right? This is why I'm mentioning it. Please be careful, right? There's a lot of stuff like this going on now, even in the crypto space. Crypto's the same way. I think the thing that people don't understand about crypto, I'm just gonna, mention this in here, is that it's not regulated the same way, stocks or even Forex is. I mean, Forex can be kind of like shady a little bit with unregulated brokers, but at least there are, some reputable, there's actually quite a few reputable brokers in this space, right? And of course, prop firms that are pretty reputable too, right? They do their payouts and stuff, right? But listen, like with crypto, stuff like that, just expect that there is a chance you could get rugged, right? Especially on like, crappy coins and stuff and tokens. So please be aware of like the asset class that you're trading and, really understand like the risk, the inherent risk that, you're taking on by investing, in crappy coins. I'm not going to mention any coins in particular, but listen, it has to be said, right? People think that it's regulated, or maybe they don't even think about regulation at all, right? But regulation is here to protect, us, traders, consumers, stuff like that, right? The most heavily regulated market is the stock market, right? So there's a lot of protection there for us, right? But cryptos don't have that, so please be careful. Don't YOLO your entire life savings into a coin just because it's gained 5,000%. That should be your warning sign, your red flag. If it's making 5,000% in a day, right? You don't want to be buying that in premium, right? And if you guys understand liquidity, right, and all the stuff behind it, right? Going off on a little bit of a tangent here, right? But it's all about supply and demand at the end of the day. Usually what it is with these coins and stuff is you have people who have all of the liquidity. They're holding a huge percentage of the total supply. Price pumps up, they dump it, they sell to everybody who's buying on the way up, right? So just a little like mini lesson on why cryptos can be very dangerous. Listen, I like cryptocurrencies. I think it's a cool technology, but we got to be careful. Do your research, please. All right, so moving on, how to handle losing and build a proper trading psychology. So this is something that I have intimate experience with because I've lost a lot. If you're new to trading or you've never been consistently profitable, you might actually be taking losing the wrong way. If you're not taking it to the chin and you're letting it affect how you make your decisions, how you do your analysis, how you execute your following trades, just because you've lost a bunch in a row, that is an issue, right? We don't want to be in a situation where we're losing and then we're letting those losses affect how we act, right? That's a very dangerous game to be playing, right? Because it hurts our consistency, right? We want to be consistent. We want to keep on executing the same way no matter how many losses we take. It's fine. If over a long series of trades you notice that, okay, I've collected a sample size of 30, 40, 60, 100 trades, right? And I can see that my expectancy is in the negatives, then okay, you have a problem. You can start making tweaks, right? But listen, so long as you stick to your plan, valid losses are inevitable and they should be taken because, again, we can't know what's going to happen next with 100% certainty. It's all probabilistic at the end of the day, right? This is why we trade over a series of trades and not on a trade-by-trade basis, right? We can never know. It's just like I said before, right? Is it a central bank manipulating price? Is it a hedge fund manager fat fingering a trade? Or was that hedge fund manager out to lunch, when he was like propping the market up at a certain level, right? Who knows, right? Losses and losing streaks are natural, and they can lead to the biggest lessons from a technical and psychological standpoint, right? What am I talking about? Listen, I've taken huge losing streaks, like I said before. It hurts, but eventually you'll stop feeling pain from it. You'll learn from it. You'll process it, and then eventually you'll start celebrating them, right? Because if those losses, again, are valid within your plan and you're taking them, then like you're doing a great job. You're like, it's perfect, right? So I always celebrate losses that are valid. And honestly, like in certain situations where, price doesn't tap me in by a tick or I get tapped out by a tick, it never really bothers me that much, right? Might be surprising, but I've had instances like that, right? Like if you looked at my my P&L calendar from the first video, I think it was October 15th or something. Or no, it was like the end of October. There was a trade I took. I got tapped out by a tick. It ran for 15R. I was like, oh, okay. Big deal, right? Maybe I should just, give myself a little bit more buffer on my trades in the future. I won't have that problem anymore, right? It's a small tweak to fix it. So what, right? There's so many opportunities in the market, right? As long as we, stay consistent with the way that we execute things, we can expect to fix small problems like that. It's not a big deal. Valid losses shouldn't bother you, like I said. And being in trades should not make you anxious. You should not be biting your nails when you're in a trade, right? Again, I've done it, right? So you're just paying. This is the way that I like to look at it. You're basically paying the market, X amount of dollars, which is your risk or your percent risk, right, per trade, just to find out what happens next, right? So I pretty much accept that, okay, as I enter a trade, I've already pretty much lost it. Now, I don't want to say that in the sense that, we're expecting to lose or anything like that. I'm not expecting anything. I'm just expecting to see price play out, right? Whether that happens to be a win and, we hit our profit target or TP or it hits our SL, it's not a big deal, honestly. And you don't want to over-celebrate winners either, right? So we want to look at, again, results from a series of trades, not on a trade-by-trade basis. Again, I'm quoting Mark Douglas on this because he's pretty much, honestly, the only expert in the trade psychology field that, you can actually trust. Like, this guy is speaking from years and years of experience, like decades of experience. Rest in peace. The guy's not with us anymore, but, another thing that he said, and I'm kind of paraphrasing on the second one, he said something along the lines in one of his seminars or something that I watched. You're not right if you win, and you're not wrong if you lose, right? And if you really break that down, it's kind of, I'm kind of echoing that in some of the previous points, right? You can take a win without having any trading plan at all, and conversely, again, we can take a loss that's valid. It's gonna happen, right? This is why we can never have a perfect 100% strike rate. It's not realistic. I don't think it's ever going to be realistic, right? Because again, we don't know the true cause of a move in the market, right? Only person who knows is the one that created that move, right? So moving on, impulsiveness and overtrading / being too conservative, right? We talked about this a little bit earlier. Overtrading. So in order to fix this problem, this is a problem that I had. These are actual equity curves from FTMO challenges that I've done in the past, right? I think this is the first time I've actually shown this kind of to the public. Well, it's not public, but I'm showing it to the Phantom community, right? Overtrading. How did I fix it? You can see on my equity curve here, I mean, this is over a month, right? I took 89 trades. Granted, some of it's partial profits and stuff, but I was going crazy. So in order to fix overtrading, set a max loss per day limit, right? Max losses per day, or a max daily drawdown limit, right? So if you cut down to less pairs or only one session, that's another way of fixing a little bit. That's something that I've done and I'm still doing. I basically just trade EU. I'm only now, a year later, kind of warming up to AU again. And I'm looking to trade it in 2022, right? And remember to journal every single trade, right? So you guys are probably wondering, what is my max loss per day limit? For those of you that maybe like have been on the Zoom back testing calls, I've probably told you guys before, or if you've watched some of my other like trade recaps, I only will take 3 losses max per day, right? And then on top of that, I'll only attack a particular trade idea twice, right? So a decisional extreme, that kind of thing. I don't want to get too technical into it, but you guys get the idea, right? I want to be conservative, right? And listen, that kind of lines up with what MFF was talking about in their little mini study that they conducted on their funded traders, right? Their most successful traders only take 2 trades a day. And they only trade, I think they also mentioned they only trade like 4 hours a day. So they're pretty much only trading 1 session. Isn't that crazy? So remember, journal every single trade. That's in bold because that's super important. Use your P&L calendar, right? Or whatever journal you want to use. I also have a written journal where I'll actually like write down and process my emotions a little bit, right? That way. Because I think, I don't know if it's like a study that said it, but I've heard that, again, take this with a grain of salt, obviously, right? I've read that apparently writing down in a journal somehow helps humans process emotions better than typing it out, or whatever other way that you want to write it down, right? Whether it's a voice note or whatever. I don't think that's an effective way of doing it anyways, but yeah, I have a trade journal that's separate from my actual P&L calendar that I literally write my emotions in, right? Why? It's so that I can like process it better and understand myself better, right? Trading is a very introspective profession, right? You really have to understand yourself in order to trade well. Now, on the flip side, being overly conservative, right? Doing daily recaps, like in order to fix it, right? And I guess, before I go into it, what is being overly conservative? Remember, it's being fearful of entering valid trades within your system, right? We want to do daily recaps and back tests to build confidence in our plan and our entry model, right? We want to take every valid trade within the parameters that you've set for yourself, right? Your active pairs, your sessions, your entry models, etc., right? That's pretty much the best way to fix it, right? It's I think the other way that I kind of fixed it for myself too was doing I've always done this where like I will do a sample size of trades, and again I'm just collecting data, right? So I'm gonna take every trade that I can that kind of fits within my plan without over trading, right? I'm still sticking to my over trading rules that are above, right? But I'm gonna go through them. I'm gonna take the trades whether I feel like it or not, right? As long as it sticks, I'm sticking to the plan, right? And then I'm going to take them and see, at the end when I've collected, 100 trades, whatever, 30 trades, whatever sample size you want to do, the more the better. Obviously, you have more statistical significance and reliability across that data set. Then you can analyze it and actually, kind of make a conclusion, right? Or draw a conclusion to it, right? Based on that data. So the thing with undertrading, remember what I said, right? You have other team members, again, that trade very little. They're conservative, right? There's nothing wrong with being conservative if you're sticking to your plan, right? Right, because in theory, say you have a very conservative trade plan where you're only taking extremely high probability setups, you could be taking 10, 15 trades per month, and maybe you have a pretty high strike rate because of it, right? Nothing wrong with that. Anyways, with the way that I trade anyways, you can see here the third one. This is one of the challenges that I passed, right? We hit 10%. And what was I doing on average? Like I said, this is what works for me. I took 30 trades over the series of a month, right? It's roughly a trade a day. Some days I didn't trade at all. And some days I would take multiple positions, right? Look, I was able to hit 10%. This is a nice equity curve too, right? So moving on, let's talk about revenge trading and how to stop doing it, right? So I'm talking more so about, actual things that you can do to stop yourself if you are struggling to actually like physically stop yourself from trading, even though you have the rule in place, right? Again, it's a thing that I've experienced in the past, which is why I wanted to mention it. So once you hit your max daily loss rule, the best thing you can do, if you have self-control problems like me in the past, I would take your MT4 terminal and hit the X button on the top right. Just hit it. Close out of it, get off your computer, go for a walk or something. Just stop trading for the day. Come back, do your recaps or something later, right? When you're not in session. And if you feel yourself chasing trades after taking a series of losses, right, in one day, or you think you know what's going to happen next with absolute certainty, like that's a huge red flag. Walk away. Same thing. Close the MT4 terminal. And again, this is a skill that can be built, right, with experience. So in my case, I don't really close the MT4 terminal anymore, but I do like minimize it, and I'll go do something else, right? And again, what's my other rule? Set a rule to only attack a single trade idea, right, within your POI or whatever, no more than 2 to 3 times, right? Because if we're going to attack a single trade idea like 4 or 5 times, like, listen, if that POI is not valid, you're going to take 5 losses. Like, that's not an easy thing to do, right? Psychologically, and it's not good for your equity curve either. Okay, next we're going to talk about finding consistency in your trading. So, again, what's an important thing to do? You either got to create or pick an existing trading plan and stick to it. There's plenty of trading plans inside of the Discord community from different coaches and team members and stuff. Pick one. You can modify it to your own, whatever, or create your own, right? If you feel like everything that you've learned from the course, you're able to put it together, and you can put together a plan that makes logical sense to you, then do that, right? I think it's better, honestly, to put your own trade plan together, because it means you'll actually test it, right? To take somebody else's trade plan and try to trade it doesn't mean you're always going to be able to make it profitable, right? Usually it's tailored to the way that you think, and it fits within your risk appetite and your emotions and your psychology and all of that, right? Number 2, stick to your trade entry model and take the same setups every single time without deviating from it, right? 3, take your losses to the chin as long as they fit within your plan, right? I feel like I've said this like 5 times now throughout this series, but remember, wins are probabilistic and probably around the corner, right? Or they're probabilistically around the corner. I don't even know if that's a real word, but number 4, journal every live and demo trade you take and ensure they fit within your plan, right? Compare it to your lower time frame entry models or whatever entry model you're using. You could be trading on the 15-minute, the 4-hour, doesn't matter, right? You should have models, and you should be able to compare them and see, okay, yeah, it actually fits that model, right? Again, I suggest the Notion P&L calendar that's in resources. And then last point is do your daily markups and recaps to identify your valid winners and losers on the pairs that you actually trade, right? It's super, super useful. And if you're looking to bring on a new pair too, or a new instrument, whatever it is, you could be trading in an indice, doesn't matter. It's the same process that I'm going through now to like bring on US 30 and Aussie dollar, right, to my plan. Right now I only trade euro dollar, but obviously before I'm going to dive into like the live market with it makes sense to actually do markups and recaps to actually understand what works on that pair, right? Because they do trade a little bit differently from EU, right? And on the right, I just have a bunch of like screenshots of equity curves from Software FX, no rewinding enabled, right? Just to show you guys, look, you could be consistent like this, right? Wish you guys knew the stuff that I've gone through and how much I've backtested. It's actually kind of stupid. Maybe it's not stupid, but it's crazy. If I were to tell you the amount of hours I've actually put into it, you'd probably think I'm a nut job. But let's talk about accepting risk and getting rid of your ego, detaching from outcome. Now, this can come in all sorts of shapes and sizes, right? First thing to ask yourself is, who are you trading for? Are you trading to get likes on Instagram or something? Honestly, if you do that, it's kind of pathetic. I'm going to be real. You should be trading for yourself and your family's financial well-being, right? Why are you trading for someone else's validation? It doesn't make any sense, right? You got to let go of outcome from each trade, and focus on the process of executing your plan flawlessly over a large series of trades, right? Again, something I've said like how many times over the series, right? This series of videos. Record all your trades, and honestly, you can use my FX book like I've done, right, to hook it up to your account and actually record some sort of like metrics on your trading, right? Plus do your Notion trade journal and stuff, so you build data on your trading plan, and you have a database of live trades you've actually put into the market, right? So you can analyze them, you can look at your losers, winners, whatever. You can kind of find a pattern in them, right? So super important. I didn't go that deep into it, but listen, at the end of the day, you have to accept the risk on all your trades. It's fine. And again, if you're doing it for clout or attention or whatever you want to call it, validation, like it's not going to work out, right? Really, you should be doing it for yourself, right? Keep trading for yourself. I think there's all this hype and stuff that's like built around trading, and it's like it's really not that, right? That's not what true trading is. It's not about you hitting like 500R. I'm over exaggerating a little bit. 500 100 R trades and then like showing it off on social media. Like, who are you really helping by doing that, right? Okay, next let's talk about approaching trading holistically and playing the long game. You want to start by building good habits from the start, right, around your trading. So you got to make use of your written journal, like I was saying, right? So you can observe, process, and learn from your emotions that you're feeling, as well as the thoughts that you're thinking while you're about to enter and while you're in a trade, right? As well as when you exit it. So those are all things that I write down in my journal as I'm trading, right? And we want to stick to trading the exact same variables, right? You don't want to tweak our plan or our risk, right? We don't want to tweak our we don't even want to tweak our plan every day, every week, or even every month, right? Consistently losing at the start is better than inconsistently winning. This is, again, something I learned at the start of when I traded Forex, right? When I switched to it. So that's super important. And then we also never want to stop looking to improve our trading psychology and technical skills, right? We want to maintain our edge. Now, risk management, I think, is fairly easy. It's you setting a certain risk parameter and leaving it static. If you're unable to do that, I would work on it because it's, like I said, it's important, right? But listen, if we stick to trading the same variables and avoid tweaking our plan more than once per quarter, then, honestly, like, you can expect some consistency, right? Because you're not changing stuff around. The only variable should be the market, really, at the end of the day, right? So if what you're doing is working, I suggest you don't change anything, right? Unless you want to, try to improve it maybe once a quarter. Don't do it frequently, right? We can slowly improve over time, but you should not be changing stuff every day, right? And again, I'm guilty of doing that. So last but not least, listen, this is just more of like a closing slide. Trading's a super difficult thing. It's lucrative, it's rewarding, right? But aside from being financially rewarding, you'll likely reap the rewards of adopting, a different type of mindset that's ultimately going to help you become more calm and level-headed as a person, right? In your journey to becoming a consistently profitable trader, right? So learning proper risk management may even help you make better decisions in life outside of trading and help you improve your judgment by helping you take more calculated risks. Not more, but better calculated risks, right? So on the right here, I have a couple things, right? I have here, this is the craziest trade I've ever made in my entire life. This was back in, as you can see, I guess, 2018. This was a penny stock, a Canadian penny stock. I'm not going to name what it is, but it was never $1.32. They did reverse splits, which is why it's a lot higher. But I basically I put basically half of my life savings into a penny stock. It shot up, as you can see, 790%. I exited somewhere around here. I made a pretty sweet profit, but listen, I could have just as easily lost my shirt on this. Look what it's at now, right? In relation to what it started at. Where I entered somewhere here, right? Look, if I had held on to it, number one, would have lost all that, and again, it could have just as easily, gone to zero, right? It was a pump and dump. This was totally a pump and dump. Again, for legal reasons, I'm not going to mention what the ticker symbol is. Just crazy, right? This is before I had any semblance of risk management. I had no stop loss, right? I just entered market. It's like, okay, let's hold on. I held on for a few months over the summer, exited. And I was like, I really thought, when I exited here, that it was going to continue going up. But, I just decided, okay, let's get out. Because this is kind of getting crazy, right? Started dropping. And I'm like, okay, I don't want to lose the gains that I made, right? So I was a little smart about it. But, again, huge risk on the table, right? So learning to trade partly helped me realize also that speeding on public roads is not worth the risk, right? And neither is risking, half your life savings on a Canadian penny stock, right? So, again, on the right, this is from me speeding in the snow without winter tires on. I got into an accident. What's the consequence of it? My insurance is really high now because of that, right? And as I'm still paying, there's still a consequence to it. I'm still paying for that, right? If you guys know anything about Ontario insurance, it's pretty crazy. So kind of sucks, right? Not only that, but you're putting people's lives at risk, right? Which is why I don't really respect people that speed on public roads. What are you doing, right? I was overconfident with my driving. I thought I was a rally driver or something, speeding, right? And I have winter tires for this car, but I just didn't put them on. This is the first snowfall. So not only that, there was also, I think, black ice and stuff, right? So I ended up rear-ending someone, right? So lesson learned. But there's a cause and effect to everything, and again, actions have consequences. So I hope you guys can take a little lesson from these two things in my life and apply it to your trading. All right, take it easy, everyone. Bye.